Hey everyone, welcome back. You wanted to know more about investment management.
That's right.
So we looked at a ton of articles, books, forum threads, you name it, to bring you, well,
The essentials.
right, the essentials of investment management. So to kick things off, I think it's worth noting that a lot of the sources we looked at emphasized portfolio construction as like the foundational element of investment management. What do you think? Is that a fair assessment?
Absolutely. I mean, building a strong portfolio is really the cornerstone of everything else.
Okay, so let's break that down a bit. I know portfolio construction can sound kind of intimidating, but I think one of the articles actually had a pretty good analogy. They compared it to building a house.
Right. You wouldn't just start throwing up walls and a roof without a plan, would you?
No, definitely not. So when we talk about portfolio construction in investment management, are we essentially talking about creating a plan, a blueprint for how our investments are going to work together?
Exactly. It's about selecting the right mix of investments, just like you would choose the right materials for your house.
I see. And each investment in our portfolio represents a different material with its own unique characteristics and purpose.
Right. You want a mix of materials that will provide stability, strength, and, of course, aesthetics. In investing, that translates to a balance of risk and return.
So it's not just about picking investments that have the potential for high returns, it's about finding that balance.
Precisely. You need to consider your risk tolerance, your time horizon, and your overall financial goals.
That makes a lot of sense. And speaking of balance, I know asset allocation is a key part of this whole portfolio construction process.
Absolutely. Asset allocation is all about deciding how much of your portfolio to allocate to different asset classes like stocks, bonds, real estate.
So it's like deciding how much of your construction budget to spend on the foundation, the walls, the roof, and maybe some fancy landscaping.
Exactly. And just like with building a house, your asset allocation should be tailored to your specific needs and circumstances.
So someone who's closer to retirement might allocate more to bonds for stability, while a younger investor might lean towards stocks for growth potential.
That's a good example. Your time horizon plays a big role in your asset allocation decisions.
Now, another concept that came up a lot in our research was risk management. And honestly, that's a big one for me, I think, for a lot of people.
Yeah.
Nobody wants to lose money.
Of course. And risk management is a critical part of investment management.
Yeah.
But it's not about eliminating risk entirely, because that's usually impossible.
Right. Every investment carries some level of risk.
Exactly. It's about understanding the different types of risk, assessing your own risk tolerance, and then managing that risk effectively.
So it's more about mitigating risk, minimizing the potential for losses, rather than avoiding it altogether.
Precisely. And that can involve diversifying your portfolio, setting stop-loss orders, and even just staying informed about market conditions.
Okay, that makes sense. Now, before we even get to picking specific investments, there's the whole research and analysis part, right? Investment research and analysis. That sounds pretty intense.
It can be, but it's also one of the most exciting aspects of investment management.
Oh, how so?
Well, it's like being a detective. You're digging into company financials, analyzing market trends, trying to uncover hidden gems.
And the goal is to find investments that align with your overall strategy, your risk tolerance, and your financial goals, right?
Right. You're looking for investments that are undervalued, have strong growth potential.
Or maybe investments that provide a steady stream of income.
Exactly. It all depends on your individual needs and objectives.
Now, once you've done your research, analyzed the market, then comes the actual security selection, right? Picking the specific stocks, bonds, or other assets.
That's right. This is where you put your research into action.
It feels almost like the culmination of all the previous steps.
It is, and it requires careful consideration.
But isn't it true that some people believe security selection is not as important as, say, asset allocation?
Yes, there's definitely debate about that. Some argue that it's more important to get your asset allocation right than to spend too much time trying to pick individual winners.
Because even if you pick a fantastic stock, if it's only a tiny part of your portfolio, it might not have a huge impact on your overall returns.
Right. And on the other hand, if you have a well-diversified portfolio with a solid asset allocation, even if some of your individual picks don't perform as well as you'd hoped, the overall portfolio should still be okay.
Gotcha. So diversification is key. And I know this is another concept that comes up a lot in investing.
Absolutely. Don't put all your eggs in one basket.
And that's really what diversification is all about, right? Spreading your investments across different asset classes, different industries, different geographies. to reduce risk.
Exactly. It's about not relying too heavily on any single investment.
So even if one part of the market takes a hit, your entire portfolio doesn't crumble. Okay, so we've talked about portfolio construction, asset allocation, risk management, research and analysis, and security selection. Phew, that's a lot. What else is there?
Well, there's also the ongoing management of your portfolio.
Right, because it's not like you just pick your investments and then forget about them, right?
Definitely not. The market is constantly changing.
So you need to adapt.
Exactly.
Hmm.
And that's where ongoing portfolio monitoring and rebalancing come in.
So you're regularly checking in on your investments, making sure they're still aligned with your goals and your risk tolerance.
Right. And if they're not, you might need to make adjustments.
Like selling some investments that have performed well and buying more of those that have lagged behind.
Exactly. That's called rebalancing.
To maintain your target asset allocation.
Precisely.
And I imagine all of this careful planning and monitoring needs to be documented, right? That's where performance measurement and reporting come into play.
Exactly. It's important to track how your portfolio is performing.
So are you measuring your returns against some sort of benchmark?
Usually, yes. You need to compare your portfolio's performance to something.
To see if you're actually doing well.
Right. And to see if your strategy is working.
This is all painting a really clear picture for me. I'm starting to see how all these different pieces fit together.
It's a process, for sure.
But it's a process that can lead to, well,
Financial success.
exactly. And I
Yeah.
think that's what we all want, right?
Absolutely.
Okay, so we've laid the groundwork. We've talked about the key aspects of investment management. And now I'm ready to dive into those different management styles you mentioned earlier, active versus passive management.
Great. That's a topic that's always up for debate.
Yeah, I've heard a lot of different opinions on this one. So let's explore that debate in the next part of our deep dive.
Sounds good. Welcome back.
All right, let's get into this active versus passive debate. I've heard a lot of opinions on this one, but frankly, I'm still not quite sure I understand the key differences. It's like choosing between two chefs.
Okay.
One who creates like custom dishes, really
Yeah.
unique, and another who specializes in perfectly executing classic recipes.
I see.
Both can be great,
Right. Absolutely.
but how do you know which is right for you?
That's a great analogy.
Mm,
With active management, you're essentially hiring a skilled chef.
a portfolio manager.
Yeah. A portfolio manager to hand-pick investments and make adjustments in an attempt to outperform the market. They're constantly analyzing trends, researching companies and making strategic bets.
So it's a much more hands-on, personalized approach,
Right.
but probably comes at a higher cost, right?
Yeah, exactly. Active management typically involves higher fees because you're paying for that expertise and the time-intensive work involved in actively managing the portfolio.
Makes sense. The big question is whether that active management actually leads to returns that justify those higher fees.
Right.
And that's where passive management comes in, right?
Yeah.
The set it and forget it approach,
In a way, yeah. Passive management is about tracking a specific market index.
like the S&P 500.
Yeah, like the S&P 500, rather than trying to beat it. It's like choosing a reliable, well-established restaurant that consistently delivers good quality food at a reasonable price.
So you're not trying to pick individual winners, you're just riding the overall market wave. It sounds simpler,
It is.
but does that mean it's less effective?
Not necessarily. Passive investing has gained a lot of popularity in recent years, and for good reason. It offers several key advantages: lower fees, broad diversification, and a historical track record that shows that over the long term, it's tough to consistently beat the market.
Okay, so both approaches have their pros and cons. Active management offers the potential for higher returns, but comes with higher costs and the risk that the manager might not actually outperform the market. Passive management is generally more affordable and simpler to manage, but it might not deliver those, eye-popping returns some investors seek.
That's a great summary. The best approach really depends on your individual circumstances, risk tolerance, and investment goals.
Now, I know there's a whole universe of investment options beyond these two main styles. Our sources mention some intriguing alternatives.
Oh, yeah.
That piqued my curiosity.
Yes. Let's step outside the traditional box for a moment. We have discretionary investment management, which is essentially delegating your investment decisions to a trusted professional.
So you're handing over the reins completely. That takes a lot of trust in your advisor.
It does. But for some investors, that peace of mind is worth it. They might not have the time, expertise, or inclination to actively manage their own investments, so they rely on a professional to make those decisions based on their predefined goals and risk tolerance.
And then there's non-discretionary investment management, which sounds like a more collaborative approach.
Exactly. In this model, the manager provides recommendations and analysis, but the client retains the final decision-making power. It's like having an experienced architect design a house, but you get to approve the blueprints and make adjustments based on your personal preferences.
So you have more control, but also more responsibility. I can see how this might appeal to investors who want to be actively involved in the process. Now, what about hedge funds? They always seem shrouded in mystery and exclusivity.
Hedge funds employ a wide range of sophisticated investment strategies, often involving leverage and alternative assets, aiming to generate high returns regardless of market direction. They're typically only accessible to high-net-worth individuals and institutional investors due to their complex nature and higher risk profiles.
It's like entering an exclusive club with the promise of greater rewards, but also potentially higher stakes. And then there's private equity, which sounds equally intriguing, but less familiar to me.
Private equity involves investing directly in privately held companies or acquiring controlling stakes in public companies. These investments are typically illiquid and require a longer-term outlook, but they offer the potential for significant returns if the companies succeed.
So you're not buying shares on the stock market, you're actually investing in the companies themselves. It sounds like venture capital, but on a larger scale.
That's a good comparison. Both venture capital and private equity involve investing in businesses that are not publicly traded, with the goal of nurturing their growth and eventually realizing a profit through an exit strategy, like an IPO or a sale.
This is all fascinating stuff. We've explored the foundational elements of investment management and delved into the key differences between active and passive styles. We've even ventured into the realm of alternative investments, but I think we're ready to get practical now.
Absolutely. Let's shift gears and walk through the actual steps involved in navigating the investment management process. It's like planning a journey. You need a map, a destination, and a clear understanding of the terrain.
Okay, I'm ready to map out this investment journey. Let's dive into those steps in the next part of our deep dive. Welcome back. I feel like we've covered a lot of ground, from the building blocks of a portfolio to all these different investment styles.
Right.
But I think now it's time to map out the actual process of managing investments. Like, what are the steps? What are the steps involved in putting all this knowledge into action?
Okay. Think of it like planning a road trip. You wouldn't just jump in a car and start driving without a destination, would you?
No, I mean, I guess you could, but
But it's better to have a plan.
yeah.
And the first crucial step in investment management is understanding, well,
What the client wants.
yeah, understanding client objectives.
So before even thinking about, stocks and bonds and all that, you need to figure out where you want to go, financially speaking. What are your goals? Your time horizon, how much risk you're comfortable with?
Exactly. It's about aligning the investment strategy with the client's unique circumstances and aspirations.
So I guess, are you saving for retirement, a down payment on a house, your child's education? Each goal has different implications for your investment choices.
Right. Because if you're saving for retirement, you have a much longer time horizon than if you're saving for a down payment on a house.
Makes sense.
So your investment strategy would be different.
Okay. Once you have that clear destination in mind, then what? It's time to develop the roadmap, right? Developing an investment strategy.
Right.
This sounds like where the real expertise comes in.
Absolutely. This involves crafting a tailored plan. A plan based on the client's objectives, their risk tolerance, and the prevailing market conditions. It's where we consider asset allocation, diversification, and specific investment vehicles that align with the overall strategy.
So it's not just about picking investments that have performed well in the past. It's
Yeah.
about anticipating future trends, navigating potential risks.
Exactly, because the past is not always a predictor of the future.
And I imagine this is where experience and in-depth market knowledge really make a difference.
They do, because developing a sound investment strategy requires a deep understanding of market dynamics, economic indicators, the intricacies of different asset classes.
And once that plan is in place, it's time to, hit the road, so to speak.
Yeah.
Implementing the strategy. Sounds pretty straightforward, but I imagine there are nuances even in this execution phase.
Absolutely. This stage involves putting the plan into action, selecting and purchasing specific investments, and ensuring all transactions are executed efficiently and in accordance with the agreed-upon strategy.
Okay. And just like on any road trip, You might encounter unexpected detours or need to adjust your route along the way.
Right.
Is that where ongoing monitoring and adjustment come in?
Exactly. Because markets are constantly in flux, and your investment strategy should be dynamic, not static.
Dynamic.
Yeah. Ongoing monitoring involves tracking performance, analyzing market trends, and making adjustments as needed to ensure the portfolio stays aligned with the client's goals and risk tolerance.
Okay, so it's an active process, not a passive one.
Right. You're constantly evaluating and adjusting based on new information and market developments.
And of course, clear communication throughout the journey is key.
Absolutely.
Yeah.
Reporting and communication are essential elements of investment management. Clients need to be informed about their portfolio's performance, understand the rationale behind investment decisions, and feel confident that their financial well-being is being carefully managed.
So transparency and open communication build trust. Make sure everyone is on the same page.
Precisely. It's about fostering a strong relationship based on understanding, shared goals, and a commitment to achieving the best possible outcomes for the client.
This deep dive has been incredibly insightful. We've covered so much. I feel like I've gained a whole new perspective on the world of investment management.
I'm glad to hear that. And hopefully our listeners feel the same way.
Yeah, we've gone from the fundamental principles of investing to, the different management styles to the actual steps involved in managing a portfolio.
It's a complex but fascinating field.
It is. And I think the key takeaway is that, investment management is a process.
It is.
And it's a process that requires careful planning, ongoing monitoring, and a deep understanding of the markets.
Right.
But with the right approach, it can lead to financial success.
Absolutely.
All right, well, that's all the time we have for today. Thanks for joining us on this deep dive into the world of investment management. We hope you found it valuable and that you'll continue to explore this fascinating, ever-evolving field.
Thanks for listening.